To the average investor, the stock market is a landscape defined by price. Charts are read from bottom to top. Gains and losses are measured in dollars and cents. And the primary question is always, how high or how low will it go? Price is the visible, tangible element of market action. It is the immediate measure of success or failure. But to focus solely on price is to observe only the effect, while remaining completely ignorant of the cause. William D. Gann, after more than 45 years of intense study and practical trading, concluded that there was a deeper, more powerful dimension governing all market movements. That dimension was time. Gann discovered that time was the ultimate factor in forecasting. He stated that when the correct time cycle arrived, the market would change its trend, regardless of what the news was or what the price level happened to be. While his contemporaries and modern analysts alike spend their careers trying to decipher price patterns, Gann dedicated his life to understanding the market's internal clock. He believed that the future was but a repetition of the past, and that by mastering the cycles of time, one could predict future tops and bottoms with a level of accuracy that seemed almost impossible. This was his great secret. Not a single simple trick, but a profound understanding that time, not price, is the final arbiter of all market trends. This is the foundation upon which his entire methodology was built, and it is the subject we will now explore in detail. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. The core of Gann's philosophy can be summarized in a single powerful quotation from the Bible, which he often cited. "The thing that hath been, it is that which shall be, and that which is done is that which shall be done. And there is no new thing under the sun." For Gann, this was not a piece of abstract wisdom. It was a literal mathematical law that governed financial markets. He viewed the stock market not as a random walk of chaotic events, but as a perfectly orderly and cyclical mechanism driven by the unchanging laws of human nature. Hopes and fears, greed and despair, these emotions are not new. They have driven men to act in the same ways for centuries, and their collective actions create patterns that repeat with mathematical precision. This belief in historical repetition was the driving force behind Gann's relentless research. He insisted that no man could expect to be successful without studying the past. He spent years, sometimes decades, compiling detailed charts of stocks and commodities, in some cases going back over 100 years. He did not do this merely to observe past price action. He was searching for the hidden engine of time cycles. He believed that everything in the universe, from the turning of the planets to the swinging of a pendulum, operated on a principle of vibration. The market, being a creation of human energy, was no different. His goal was to discover the unique vibratory rate of each stock and commodity, to understand its individual rhythm, and to use that knowledge to project its future path. This required a complete shift in perspective from traditional market analysis. Where others saw noise, Gann saw order. Where others saw randomness, he saw a divine mathematical plan. This is why he placed such immense importance on having records. He wrote, "The more you study past records, the surer you are to be able to detect the trend of the future." His charts were not just a record of prices. They were a laboratory for studying time. He measured the time elapsed between major tops and bottoms, between minor swings, and even the time a stock spent in a consolidation period. He found that these time periods were not random, but tended to repeat in predictable, harmonic patterns. This discovery, that time itself was a measurable and predictable element, was the first great secret to his method. He taught that by knowing the history of a stock, its habits, and the time cycles that had governed it in the past, one could forecast its future turning points with confidence. He was not guessing. He was calculating, based on the immutable law that what has been will be again. In the world of market analysis, price and time are often seen as two equal components of a trend. For William Gann, this was a fundamental error. He declared unequivocally that time was the most important factor of all. He wrote that time can overbalance price, meaning that once a major time cycle has run its course, the force of time alone is sufficient to reverse the trend, even if the price patterns still appear bullish or bearish. This is a concept that is almost entirely absent from modern technical analysis, yet it was the cornerstone of Gann's work. To understand this principle, we must first understand how Gann viewed the market. He saw it as a structure that was constantly seeking equilibrium, or balance. A market could become overbalanced in price, meaning it had moved too far, too fast in one direction, but more importantly, it could become overbalanced in time. This happens when a market has been advancing or declining for a period that completes a major historical time cycle. When this time point is reached, the market is ripe for a reversal. The accumulated energy of the trend is exhausted, and the slightest pressure can start a move in the opposite direction. Consider an example. A stock has been in a powerful bull market for 49 months. This 49-month period is a key cycle Gann identified, 7 by 7. As the stock approaches this 49th month, even if the news is good and the price is making new highs, a Gann analyst becomes extremely cautious. He knows that the time factor is about to exert its pressure. He is not looking at price patterns for a sign of a top. He is looking at the calendar. When the 49th month arrives and he sees the first sign of weakness on his charts, perhaps a break of a 3-day swing bottom, he has his confirmation. The time was up. The trend has changed. A trader focused only on price would have been caught completely unaware, but the trader who understood the supremacy of time was prepared. This concept of time being the overriding factor explains why markets so often seem to defy logic. Stocks can and do go up on bad news and go down on good news. Why? Because if the time cycle for a decline is complete, no amount of good news can stop the new trend from beginning. The internal force of the time cycle is more powerful than the external force of the news. This is why Gann was able to forecast market turns months and sometimes years in advance. He was not forecasting the news. He was forecasting the expiration of the time cycles that would inevitably reverse the trend. This leads to another of Gann's critical rules. Never enter a market simply because the price is high or low. A stock that looks too high can continue to advance for many more months if its time cycle is not complete. Conversely, a stock that looks cheap can continue to decline for a very long time if it is still in a bearish time cycle. The final decision to buy or sell must be based on a confluence of factors, but the most important of these is always time. It is only when the time is right that a significant and sustainable trend change can occur. By learning to measure these cycles, the trader moves from the world of guessing to the world of scientific calculation, using time as his ultimate guide to market forecasting. For Gann, the smallest vibrations of the market were just as important as the largest. He understood that major trends were simply the sum of many smaller harmonic swings. Therefore, his analysis of time began at the most granular level, the day. In his book, 45 Years in Wall Street, he outlined several rules based on short-term day counts that are critical for navigating active, fast-moving markets. One of the most significant of these is the 2-day reaction and rally rule. In a powerfully trending bull market, when demand is overwhelming supply, reactions are extremely shallow and brief. Gann observed that corrections would often last only 2 days before the upward advance was forcefully resumed. The failure of the market to decline for a third consecutive day was a potent sign of underlying strength, indicating that buyers were aggressively meeting any and all selling pressure. For a trader already holding a long position, this was a signal to hold firm. For a trader waiting to enter, buying after a 2-day pullback offered a low-risk entry point in harmony with the primary trend. The inverse is true in a fast-declining bear market. Feeble rallies would often exhaust themselves after only 2 days, providing a clear signal to initiate or add to short positions. The inability of the market to sustain a rally for a third day was proof that the selling pressure remained the dominant force. Building upon the daily analysis, Gann developed one of his most important trend-following tools, the three-day swing chart. This chart was designed to filter out the insignificant minor fluctuations and reveal the true minor trend of the market. The rule for constructing this chart is precise. A trend is considered to be moving up as long as it continues to make higher highs and higher lows. You only record a change in trend from up to down after the market has had 3 consecutive days with lower highs and lower lows. At that point, the trend line on the chart is moved to the low of that third day. Conversely, after a decline, the trend is not considered to have turned up until there are 3 consecutive days of higher highs and higher lows. Crossing the top of the last minor swing on this 3-day chart was Gann's first and most immediate signal that the trend had turned up, at least temporarily. He used this tool to confirm his entries and exits with precision. For example, after the final low in April 1942, he noted that the 3-day chart confirmed the uptrend in May 1942, and it would have kept a trader on the long side of the market all the way to the major top in 1946, with only minor normal reactions along the way. Beyond these immediate reversal patterns, Gann cataloged a series of short-term day counts that consistently marked the termination of minor swings. In his review of market swings, he identified the periods of 7 to 12 days, 18 to 21 days, and 28 to 31 days as being of critical importance. A minor advance or decline that had run for approximately 7 to 12 days was often due for a reversal. A move that extended beyond this initial period was to be watched with extreme care around the 18 to 21 day mark, and again at the 28 to 31 day mark, as these were high probability windows for the culmination of a minor trend. These are not arbitrary numbers. They are the result of Gann's exhaustive study of countless market swings, where he found these time periods repeating again and again. A trader using these cycles would be on high alert for a change in trend as these time points approached, using his other tools, like the 3-day chart, to confirm the exact moment of the turn. As we expand our lens from days to weeks, we begin to analyze the time cycles that govern the more significant corrective waves within major bull and bear markets. Gann established a clear hierarchy of these medium-term cycles, which he used to gauge the health of a primary trend and to identify high-probability entry points. The first and most fundamental of these is the 3 weeks reaction. In his trading rules, he states, "Buy on a 3 weeks reaction or decline in a bull market when the main trend is up, as this is the average reaction in a strong bull market." This was a cornerstone of his strategy. He understood that no market moves straight up. A healthy bull market must breathe, and these 3-week pullbacks were the natural inhalations in a long advance. They served to shake out weak holders and allowed the market to build a stronger foundation for the next wave up. For the patient trader, these 3-week reactions provided ideal opportunities to enter the market with the trend, often at a much lower risk than buying into the strength of an advance. Similarly, in a confirmed bear market, a rally that extended for approximately 3 weeks was considered a prime opportunity to sell short. When a market reaction or rally extended beyond the 3-week period, Gann turned to the next set of important time cycles: 42 to 49 days, 6 to 7 weeks, and 57 to 65 days. The 7-week or 49-day cycle was of particular importance, representing the square of the significant number 7. If a correction in a bull market ran for this length of time, it signaled a much deeper and more significant test of the trend, but often marked the final low before a powerful resumption of the advance. The 60 to 65-day period was even more critical. Gann described this as about the greatest average time that a bear market rallies or a bull market reacts. Therefore, if a stock in a primary bull market had been declining for nearly 2 months, it was approaching a major time support level. A trader would begin to look intensely for signs of a bottom, knowing that the time cycle for the correction was likely complete. These medium-term cycles provided Gann with a roadmap. They allowed him to measure the duration of a corrective wave against historical precedent and determine whether it was a minor, normal reaction or a sign of a more significant change in the primary trend. The next layer in Gann's time analysis involves the great seasonal and yearly cycles that influence all markets. He discovered that year after year, certain months and even specific dates within those months had an extraordinarily high probability of producing a change in trend. This was not due to any mystical force, but to the natural, seasonal rhythm of business, agriculture, and human psychology. In Chapter 8 of 45 Years in Wall Street, he provides a detailed calendar of these critical time points, which he urged his students to watch with the utmost attention. He identified January, specifically the periods of the 7th to the 10th and the 19th to the 24th, as a key month where trend changes lasting for weeks or even months often begin. February, 3rd to 10th and 20th to 25th, was also of great importance. March, 20th to 27th, and April, 7th to 12th and 20th to 27th, 25th, were noted for both minor and sometimes major turns. May, 3rd to 10th and 21st to 28th, was considered to be as important as January and February for producing major tops and bottoms. June saw minor changes, while July, being the midpoint of the year, was another critical month for major reversals, second only to January in importance. However, the most important month of all, according to Gann's research, was September. He stated, "These periods are the most important of any in the year, especially for tops, or final highs in a bull market, as more highs have occurred in September than any other month." He advised watching the periods of September 3rd to 10th and 21st to 28th with extreme care. Following September, he identified key periods in October, November, especially in election years, and December, with the period from mid-December into early January, being a consistently reliable time for a change in trend. By keeping this calendar in mind, a trader could anticipate when the market was entering a time window where the probability of a reversal was exceptionally high. The final and perhaps most profound of Gann's time tools was his use of anniversary dates. In his extensive research, he discovered that markets have a long-term memory. The dates of major historical highs and lows were not forgotten. They became powerful vibratory points in the future. He found that a market would often experience a major change in trend on or near the anniversary date of a past major top or bottom. This principle applied to one-year anniversaries as well as those spanning multiple years, such as 2, 3, 4, 5, and even 10 years or more from a significant event. In Chapter 9 of 45 Years in Wall Street, he provides a detailed record proving the value of this rule. He identified the all-time high of September 3rd, 1929, and the extreme low of July 8th, 1932, as two of the most important anniversary dates to watch each year. He then systematically demonstrates how these dates, and the dates of other major turning points, consistently coincided with market reversals in the subsequent years. For example, he points out that in 1933, the high for the year occurred on July 18th, just 10 days after the anniversary of the great 1932 low, and the high of the secondary rally occurred on September 18th, 15 days after the anniversary of the great 1929 high. This was Gann's method of projecting the future based on the past. A trader using this tool would create a calendar of all the major tops and bottoms for the stock or market he was following. As these anniversary dates approached on the calendar, he would become increasingly alert for a change in trend, knowing that the market was entering a period of high vibratory energy. This was not a standalone signal, but a powerful alert that told him when to pay the closest attention to his charts and other rules. By understanding these anniversary dates, the Gann trader could see potential turning points on the horizon long before they became apparent to the rest of the market, providing an unparalleled forecasting edge. Gann's study of price was just as meticulous and mathematical as his study of time. He did not view price levels as random numbers, but as specific vibratory points that acted as powerful zones of support and resistance. His primary tool for identifying these critical price levels was the calculation of percentages based on major historical highs and lows. While he used many divisions, the most important of all was the 50% level. He stated, "The most important resistance level is 50% of any high or low price." This rule formed the bedrock of his price analysis. He calculated 50% of the all-time high price of a stock and 50% of the range between any major top and bottom. These halfway points were, to him, natural points of equilibrium, or gravitational centers, where a trend was most likely to halt and reverse. The true genius of his method was in combining this price analysis with his time cycles. A major time cycle ending was a significant event, but if that time cycle culminated with the price reaching a major 50% resistance level, the signal was magnified tenfold. Consider the great bull market that ended in March 1937. The Dow Jones Industrial Average reached a high of 195.50. Gann would have immediately noted that this price was just above the 50% level of the 1929 all-time high of 386.10, which is approximately 193. This was a massive price resistance zone. Now he would turn to his time analysis. The bull market began in July 1932. From that low to the high in March 1937 was a period of 56 months. This was the confluence he was looking for, a major price resistance level being met at the end of a major time cycle. This was not a guess. It was a calculated signal of the highest order, indicating that the bull market was complete. This synthesis of price and time works in all degrees of trend. If a stock has advanced 40 points in 40 days, it has squared its price and time, creating a state of perfect equilibrium where a reversal is highly probable. If a 7-week advance culminates at a price that is 50% of the last major downswing, the probability of a top is extremely high. The Gann trader is constantly performing this dual analysis. He asks not only how long has the market been moving, but also how far has it moved in relation to past price structures. When the answer to both questions points to the same conclusion, the signal is clear. He does not act when only one factor is present. He waits with the patience that is the hallmark of a professional for that moment of perfect synchronicity between price and time. Even with a powerful confluence of price and time, Gann still required a final confirmation before acting. This confirmation came from the market itself, through the price action recorded on his charts. Time cycles, no matter how reliable, was still a forecast. The chart was the present moment truth. A time cycle could indicate that a top was due, but the trend was not considered to have officially reversed until the price action on the chart confirmed it. His primary tools for this confirmation were the 3-day and 9-point swing charts. Let us reconstruct the process of a master trader using these tools. Imagine a major bull market has been underway for nearly 2 years. The trader consults his timetables and notes that a major anniversary date is approaching, 2 years from the last significant low. He also calculates his percentage levels and sees that the current price is approaching a 100% advance from a previous bottom, a key resistance level. He now knows that the market is entering a critical time and price window where a major top is probable, but he does not sell. To do so would be to act on anticipation, which is a form of guessing. Instead, he turns to his 3-day and 9-point swing charts and watches them with extreme focus. The uptrend is defined by a series of higher tops and higher bottoms on these charts. He knows the trend remains intact as long as this pattern continues. The market enters the time window, the price hits the resistance level, and the volume becomes climactic, but still, he waits. Then it happens. The market has a sharp break, and for the first time in many months, the price declines for more than 3 consecutive days, breaking the last swing bottom on his 3-day chart. This is his first confirmation. A few days later, the decline continues and breaks the last bottom on his more significant 9-point swing chart. This is his final, irrefutable signal. The time was up, the price resistance held, and now the chart has confirmed the change in trend. He now sells his long positions and initiates short sales, not based on hope or fear, but on a logical, step-by-step process where every element has confirmed the other. This methodical integration of time forecasting with real-time chart confirmation is what separated Gann's scientific approach from the pure guesswork of his peers. The third and final dimension of Gann's integrated approach was volume. He understood that volume was the force, the effort that drove price movements. A change in trend that was indicated by time and confirmed by the price chart was considered even more reliable if it was also validated by the volume signature. At a major top, when a long-term time cycle was expiring and the price was meeting heavy resistance, Gann would expect to see a massive increase in the volume of sales. This climactic volume was the proof that distribution was taking place on a grand scale. It was the sound of the composite man unloading his vast holdings to an excited public. The harmony of a time cycle top, a price resistance level, and a volume climax constituted the strongest possible signal that a bull market was over. Conversely, at a major bottom, after a prolonged bear market had completed its time cycle and the price had declined to a major percentage support level, he would look for one of two volume signatures. The first was a high-volume selling climax, which indicated that the final wave of panicked selling was being absorbed by strong hands. The second, and often more powerful, was a period of extreme dullness and low volume. This indicated that the selling pressure had been completely exhausted, that the supply had dried up, and that the market was in a perfect position to reverse. The time cycle told him when to look for the bottom. The volume signature told him how that bottom was being formed. This three-way confirmation, time, price, and volume, was the key to his greatest forecasts. No single factor was trusted alone. He demanded a consensus from all three before he would risk his capital on a major position. In conclusion, the secret to W.D. Gann's trading strategy was not a single indicator or a simple formula. It was a complete, holistic methodology built upon the profound and revolutionary idea that time is the ultimate governing factor in all markets. But his genius was in not treating this principle as an abstraction. He made it practical by integrating it at every step with his rigorous analysis of price and volume. His method was a symphony of these three elements working in harmony. He taught that to be successful, a man must first acquire knowledge. He must do the work. He must dedicate himself to the study of the past, to the compilation of charts, and to the unwavering application of time-tested rules. He showed that the market is not a place of chaos, but a machine of beautiful mathematical order. For those willing to learn its mechanics, to understand its rhythms, and to respect its immutable laws, the market offers limitless opportunity. The path is not easy. It requires patience, discipline, and a deep desire to understand the truth. But as Gann proved with his own legendary career, for those who make the effort, speculation can be transformed from a game of chance into what he rightly called it, a profitable profession.